Risk management is one of the most important aspects of trading, arguably the most important aspect, because the more you can protect your capital when you're on the wrong side of a trade, the easier it's going to be to grow your capital when you hit those profitable trades. And at the end of the day, if you lose all of your capital, you're not trading at all. So a big part of risk management is limiting how much you can potentially lose on a trade. For most traders, this is going to come down to a combination of two things. Your position size, which we discussed in a previous video, click up here to watch that, and how far the price moves against you. As you can see from the calculation on screen, this dictates how much you can lose on that trade. So that means it's important that when we enter a trade, we already know where we would exit if the trade ends up losing. And once we've determined where that price point will be, we then need to decide how we're going to exit a trade if the price gets there. So one option is to simply close the trade manually if the price gets there. However, this can create a number of different problems from both a practical and a psychological point of view. Like for example, loss aversion could stop you from closing the trade when you should be, or it might be that the price is moving too fast and you're not quick enough to close the trade, therefore resulting in an even bigger loss than you first anticipated. Instead, an easy solution to all of this is to make use of a stop loss. A stop loss is a type of order that you place with your broker, and the way that it typically works is like this. So you set it to a particular price, and if that price is reached, the broker will execute a market order on your behalf, meaning that your trade will be closed at whatever the best available market price is at that point in time. Now, it's possible to do this for your whole trade, or if you want to, you can just do it for part of the trade, if you're just looking to scale out part of the position. Now, if you have a long trade, meaning that you were a buyer in the market, your stop loss will be positioned below the price and would be a sell order. Whereas if you have a short trade, meaning that you were a seller in the market, your stop loss would be above the price and it would be a buy order. Now, since most stop losses, once they're triggered, will be executed as a market order, it means that you're going to take whatever price you can get in the market to execute immediately. So just because you set your stop loss at a particular price, that doesn't mean that's the price that you're going to close at. Instead, that's the price that your stop loss gets triggered at, and your market order will get filled at whatever price is available in the market at that time. This means that you may end up with what's called slippage, which is where the price that you're executed at, your market order is executed at, is different to the price that your stop loss was triggered at. But while you're just getting started with learning to trade, this really isn't something you need to worry about. You don't need to understand all of this stuff. Just the basics of stop losses, that's more than enough. Just knowing what they're there for, how to set them, and so on. But we will be covering all of this stuff in future videos, so make sure you're subscribed to the channel so you don't miss any of those. And if you want to know how I've traded for the past 2 decades, check the description box down below for more info about that. Thanks for watching.